You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koós, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Hello, everyone, and happy Friday. Do you own bonds, bond mutual funds, or bond ETFs in your retirement portfolio? And if you do, are you confused as to why they've been going down lately? Wait a minute. Aren't bonds supposed to be safe? Well, kinda, but not necessarily, and that's what we're going to be talking about today. But before we get into it, as always, a few housekeeping items. If this is your first time listening or watching, then thank you so much for joining us. The Cash Podcast is produced weekly, and as stated in the intro, Cash stands for creating affluence, success, and happiness. And that's our mission. My hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So come back often. Feel free to subscribe on both iTunes and YouTube. In addition, you can also follow me on Twitter at Adam Koós and on Instagram at Financial Surgeon. And last but not least, all links, visuals, charts, and other educational resources are always available on our website. Today, we're going to be talking about bonds, interest rates, different types of bond investments, those that are doing well, those that are not doing well, why the ones that are doing well, and why the ones that aren't doing well aren't doing well. And so we're going to have some charts, we're going to have some tables, and we will be posting those on our website on the podcast page at libertaswealth.com for those of you who are listening on iTunes and cannot see the charts. As always, I'll do my very best to talk you through them and won't pretend like we're watching a movie here. So without further ado, let's move on today. I always like to start with a quote, and today's quote is appropriate. It's Jack Bogle. He is an investor philanthropist, and he said, "Learn every day, but especially from the experiences of others. It's cheaper." A whole lot cheaper, actually. So the reason why I felt like that made a lot of sense today is because most people don't know that there are so many different types of bonds out there. Most people think stocks and bonds. So you've got stocks and you've got bonds, but it goes so much deeper than that. And I think when it comes to stocks, I think a lot of people know that there's large company stocks, medium-sized company stocks, small company stocks. I think people know that there's international and domestic, and of course there's technology and biotech and financials and utilities. So I think most people generally understand that there's different types of stocks, different sizes, different geographics in terms of where they're located, internationally speaking. But I don't think most people realize that there are so many different categories of bonds and so many different ways to invest in bonds, just like stocks, actually, if not. But it's not the same. It's different, and that's what we're going to talk about today. So first and foremost, I just want to kind of go through the different types of bonds that exist out there. And I'm just going to, for those of you who are watching, I'm putting the whole list up on purpose. Again, for those of you listening, you can check this out later and see the whole list, but I'm just going to talk you through it. So the first type of bond we can invest in are just government bonds, U.S. Treasuries, so T-bills, T-notes, backed by the full faith and credit of the U.S. government. It's about as safe as it gets. Then the second would be maybe floating rate, and these are in no order, by the way. So floating rate, when you think of a floating rate bond or a floating rate portfolio of bonds, think, a variable rate, not fixed, like most bonds have a fixed rate. Floating rate does not, hence the word floating. It floats. It changes like the LIBOR, for instance. It changes over time. The Fed funds rate changes over time. So a basket of floating rate securities would have a variable interest rate that changes over time, unlike a fixed interest rate on, say, a U.S. Treasury bond. Senior loans is the third type that we're going to talk about. So senior loans are, the way you have to remember them is, they're called senior loans because of the seniority in which they get paid back. So if when these loans are paid back, the senior loans are one of the first to get their money back, or I should say the lenders. And that would be you in this case. If you're taking and giving your money or lending your money to a corporation, you're one of the first people that are going to get your money back if you're using senior debt. The next type is what's called a municipal bond. These are bonds that are issued by municipalities. So examples would be states, schools, airports. There's all kinds of different things in your state. For instance, we're in Ohio, so if we had a Columbus airport bond, let's just say, that's obviously a municipal bond because it's being issued by the airport. You would have an interest rate that you would get paid to lend your money so that the airport can use that money to build maybe a new runway. And then what's nice about municipal bonds is that especially if you buy them in your own state, the state of your primary residence, they're federally, state, and local tax-free, or at least federally and state tax-free. So, if you bought a municipal bond, say if you live in Ohio but you bought a municipal bond in California, you would still get the federal tax-free treatment, but you'd still have to pay your state income tax, assuming your state has an income tax, of course. Next type of bond would be a zero coupon bond. When you think of zero coupon bonds, I call them zeros, just for short. They don't have any interest. So zero coupon bonds are sold at a discount. So you're gonna basically, let's just say you start at a very low dollar amount, and then eventually at the end of maturity, the bond goes back to par, which let's just say is 100, and that's how you make your money. So unlike most bonds where you invest money at par, say if you invest $1,000 in a bond and then you're going to get an interest rate every month or every quarter, let's just say, and then at the end of the maturity rate or the maturity date, then you get your money back plus all the interest you accumulated over time. With zero coupon bonds, there's no interest. You're getting it starts small and then you end up with the par value at the end. So that's how it grows. Corporate bonds, obviously lending money to corporations. Here in Columbus, Ohio, we've got your, Scott's Miracle-Gro and Cardinal Health, and think of the other publicly traded companies, Limited, so L Brands, and so on. If these companies, instead of issuing stock for sale, they can ask, say we're going to underwrite a bond, and you can lend your money to them, and so they're borrowing your money, and then they're going to pay you an interest rate for it. Another type of corporate bond are what are called convertible bonds. And actually, convertible bonds, as you'll see in a minute here, are one of the better performing bond investments you can own right now because they can convert based on a predetermined formula into common stock. So they're bonds, but they can turn into stock, which gives them a little bit more growth potential than, say, a typical corporate bond. Next type would be mortgage-backed securities. When you think mortgage-backed securities, think things like Ginnie Mae, Freddie Mac, Fannie Mae. So, first-time home buyers might be using a Fannie Mae loan or something along those lines. So these are basically big baskets of securities or money that's then lent out to people who are buying homes, and they're borrowing money, obviously, on a mortgage to buy that home. Next type would be what's called high-yield bonds. High-yield bonds are also known as junk bonds, and the reason for that is because either A, they did not pay for the insurance, whether that's through one of the many insuring companies out there to guarantee the interest payments. So either A, they didn't pay for that insurance to guarantee interest gets paid no matter what happens to the issuing company, or they are a lower-rated company based on their financial ability to pay back the interest, or both. So what happens is that whenever a company issues a bond and decides to pay for insurance, they have to do just that. They have to pay for it. So if they don't pay for the insurance, then obviously that gives them the ability to keep some more money in their pocket and maybe pay you a higher interest rate. Of course, in the case where they're just lower rated, like a lower rated company in general, then you deserve a higher interest rate because you're taking on more risk with a lower rated company. But the reason they're called junk isn't literally because they're junky securities. It's just a name they've been given because of the fact that it is a higher risk bond investment. The next type is really interesting. It hasn't necessarily been something that people talk a whole lot about until recently, I think. But they're called Treasury Inflation Protected Securities, or TIPS for short. And TIPS go up when inflation goes up. Now, the issue we've had for the last 3 decades is there hasn't been any inflation in this country. So it's been difficult to see TIPS do anything stellar when obviously the whole purpose of these investments is to go up when inflation goes up, and there really just hasn't been all that much inflation. So recently, though, as we've started to see interest rates go up, as we've started to see commodities are doing well right now, but the potential for inflation starts to maybe come around the corner here, then we may see these TIPS start to perform better. Similarly speaking, there's international bonds. Now, international bonds can be sovereign debt, so government bonds, kind of like U.S. Treasuries, but instead we're looking at government bonds of other countries. It can also be WIPS, as we call them, or world inflation protected securities, which are like TIPS, except you're buying them around the world. So if the inflation in those countries go up, then obviously these securities would appreciate in value. And then the last one here, and there's a couple more categories that I've left out on purpose just because I feel like this is enough weeds for one podcast. But the last category here is what's called shorting bonds. Now, if you didn't catch our GameStop, Reddit, Wall Street Bets podcast a couple weeks ago, and you want to know what shorting is or how it works or what went on during all that craziness with GameStop and BlackBerry and all these companies that were shooting up in value due to short interest and short squeezes, then please head over to that podcast and check it out. I don't want to duplicate efforts here or bore the people who've watched that one with another education on what shorting is. But in short, no pun intended, when you short bonds and you're expecting them to go down in value, because the issue is, if you think rates are going to rise, you can't really invest in rates. In other words, you can't go buying a bond that goes up when rates go up, necessarily speaking. Now, there's some investments out there that are kind of like that, where if rates rise, like floating rate, for instance, then you'll see an appreciation. But if you think rates are going to rise on the 30-year Treasury or the 20-year Treasury or 10-year Treasury, or just in general on corporate bonds, let's just say, then you might want to short bonds. Because when bonds go down, then we make money, and that's how you make money. Shorting is that when the value of the security you're shorting goes down in value, you actually make money. It's the exact opposite of owning it. Which, for those of you who don't know, who aren't aware, it's when you own when you own any investment, whether it's a bond or a stock, it's called you're long X shares of whatever that stock is. So if I have 100 shares of Apple, I own or I'm long 100 shares of Apple. But if I short Apple because I expect it to go down, because I think Apple's going to go down in price, of course, then I'm short 100 shares of Apple. And if it goes down to 90 from $100, let's just say, then I cover my short position at 90 and I make $10 a share. But that's, in short, again, no pun intended, that's how shorting works. But that's another way that we can make money in the bond market, is by investing in an ETF, let's just say, that shorts the bond market when interest rates are going up and bonds are going down. So, speaking of the difference between interest rates and prices, I want to explain that because it's really, really important. In fact, I think it's one of the most misunderstood things about bonds in general, is that when interest rates go up, obviously people are happy because they think, oh, I can buy a CD at the bank and get a higher interest rate, or I get a higher interest rate on my savings, let's just say, or my money market. That's true, but if you own a bond and you bought it last year at $100 at par, let's just use $10,000. If you buy a $10,000 bond and it's a 30-year bond, then there's this seesaw effect that takes place. And the way the seesaw works is, as interest rates go up, bond prices or bond values go down. This is not a matter of speculation. This is not an economic report or a market outlook. This is how it goes. This is literally mathematically how bonds and interest rates work. They're inversely proportionate. So again, when interest rates go up, the value of your bond portfolio goes down. When interest rates go down, the value of bonds goes up. So because because interest rates since the early 80s have been going down pretty steadily for the last several decades. And you got to think back to, for those of you who are old enough, think back to what you were paying on your mortgage back in the 80s. Think of what you were getting on CDs at the bank back in the 80s on your savings account. It was so much different back then. You'd be paying 14% on your mortgage. These days, people are paying on a 15-year mortgage, they're getting below 3%. So it's so much different now than it was back then. But the reason bonds have been so quote-unquote safe and done so well over the last few decades from a capital appreciation standpoint is because interest rates have just gone down and down and down and down and down. So now what we have, I don't think interest rates are going to start screaming northward anytime soon. I mean, they've been going up lately this past few months, as I'll show you in a second here. But when interest rates go up, bond values go down. And that's why if you own some traditional long-dated or intermediate term even bonds, corporate bonds, treasury bonds, government bonds inside your portfolio, as interest rates go up, then the value of those bonds are going to go down in value. And furthermore, the longer the maturity date. So if you look at this seesaw, if you have a 10-year or a 5-year bond, then it's not going to fluctuate nearly as much. Picture that seesaw, that point near the apex here, or in the very middle of the seesaw. When interest rates go up, you're not going to feel it as much as, say, when interest rates go up at the long end. So on the 30-year note, you can see that end of the seesaw is going to sway a huge amount, and it's going to affect your bonds a whole lot more if you own longer dated bonds than you would if you had shorter dated bonds. So now that you understand that, let's take a look at the 10-year Treasury note, which is so here's the Treasury yield on the 10-year Treasury, U.S. government bonds, or government yield. And you can see how the yields bottomed here in March very briefly, right during COVID, during the initial pandemic and the lockdown when that was all starting. They bounced, kind of chopped sideways, bottomed again in July, August-ish. And then since then, it's been kind of a steady trend upward here. And so now what we're seeing rates on the 10-year Treasury starting to butt up against the short-term highs in March and then the longer-term lows going back to 2019. And I think that's one of the places, as I'll show you in a second here, where I think it might stall and we might start to see some sideways choppiness again. But right now, as these rates have been going up, the next thing I want to show you here, and for those of you listening on iTunes, what we're looking at is interest rates have been going up since pretty much late August. And any pullback has been brief and met with additional rising of rates. So interest rates just keep going up. It's not, again, we're not, for those of you that are wondering, oh, should I go buy a house right now? No, it's not an emergency. Interest rates don't scream northward like stocks do. It's a very slow bottoming process. So, but if you're watching on YouTube, you're going to see how inversely proportionate the 10-year Treasury bond is relative to the 10-year Treasury yield. So here we have, since July, August, rates have been going up. Now I'm going to show you the next slide is since July, August, bonds have been going down. And so there you have that exact picture, or that inverse relationship comparing interest rates and bonds, so that, again, when interest rates go up, bonds go down. When interest rates go down, bonds go up. And if you're curious, again, why I was looking at that, call it 1.4% level as a potential ceiling above our head of resistance, as you can see, if you go back to 2012, yields on the 10-year note bottomed right around 1.4. Then there was a bounce up to around 3-ish, 3%, 3.1. Then they bottomed again at 1.4, just below 1.4%. They spiked back up to around 3.3%, and then they fell again, and then COVID hit, and they pretty much fell through the trap door and headed down to close to zero. So I'm not laughing because it's funny. It's just pretty spectacular, honestly. There's probably several words I could use to describe it. But so now what we have now is what was a floor of support before has now turned into a potential ceiling of resistance going forward. So what I would expect to see happen here would be for yields to kind of hit this 1.3, 1.4 level here in the near future, and then to maybe see some chop, some sideways movement and some digestion as time goes on, which would fare well for some bonds in the near future. However, if that's not the case, and if it breaks right back above that trap door range that we saw during COVID, and we see interest rates going up to 1.4, 1.5, 1.6, I think that we could see some serious trouble in the stock market at that point as people start going and leaning for higher interest rates in the short term, putting money into fixed income and security and bond securities as opposed to stocks, maybe taking profits off their stock investments, putting them into bonds as interest rates rise. So that's something to keep in mind. Second to last thing I want to show you here, we talked about all these different types of bonds, and we talked about how, if you own bonds in your portfolio, you might be losing money and you might be confused as to why. What we're looking at here, and I'll just talk you through it on iTunes, is a bunch of different types of bonds. I didn't add every single one, but what we have here are 8 different types of bonds. The 20-year Treasury, TIPS, international bonds. We have shorting the bond market, or shorting the 20-year Treasury. We have floating rate, money market, basically, very, very flat number, of course. Money market hasn't gone anywhere. World inflation protected securities, and then zeros. And when you compare all of these investments to one another, going back to April of last year, so April of 2020, what you would find is that the world inflation protected securities are up 18.5% almost. This is while the we've got all these other. So I'm going to go from top to bottom. I'm not going to name every one of them, but 18.5%, 15.6%, 10.95. We'll call that 11%. Is what shorting the bond market would have done for you this past, we'll call it 10 months. And then we have the TIPS, so Treasury Inflation Protected Securities, up 6.8%. And then we have floating rate up 4.27%. We have money market or just, short, ultra short term bonds, T-bills, T-notes down about 0.13%. That doesn't count the interest though, so it would be pretty much flat. But then if you look here at you've got 20-year treasuries, so treasury bonds at down 13.01% right now. And then here's another one down, zeros are down 18.56. So if we're looking at 10-year, 20-year treasuries, zero coupon bonds still, 30-year zeros, they're down double digits, closing in on 20%. And again, we thought this is safe stuff here, right? But so what we have to start paying attention to, as an investor, as somebody who has serious retirement money that you want to grow and protect, is you have to keep in mind that bonds aren't going to be safe all the time going forward, because I just don't know that we're going to have this steadily decline of interest rates that we've seen for the last 30, 40 years. So instead, I think you got to be really careful how you construct your bond portfolio, and instead of just buying corporate bonds and government bonds and leaving it to being long all the time, long bonds all the time, instead I think you have to look at diversifying your bonds across different types of bonds, different categories as bonds. So, start looking at Treasury inflation protected securities, start looking at floating rate, world inflation protected securities, international bonds. I didn't put it on here because it would make this whole chart look absolutely ridiculous, but convertible bonds have done well. Now they're much higher in risk than a typical bond, but again, they tend to correlate more with the stock market because these bonds and convertible bond portfolios can convert to stock as well. So those have done really, really well. So what we want to do though is we don't just want to diversify our portfolio and buy every single bond category that's out there. I always compare it to the playoffs of any sport. It doesn't matter whether it's NFL. We just had the Super Bowl, so I'm using a Super Bowl analogy here. But it doesn't matter if it's the Super Bowl, if it's the NHL playoffs. It doesn't matter if it's the Olympics. Whatever the case is, we want to be investing our money in the best, strongest, on a relative basis, the best relative strongest performers in the bond market. So right now, we wouldn't want to be touching long-dated treasury bonds and long-dated zeros and long-dated corporate bonds. We'd want to be really, really careful unless we were trying to catch that falling knife and turn the corner for a potential drop in rates. But to me, that would be anticipation, and I would be less interested in being aggressive and trying to catch that falling knife as bonds are falling and hoping to catch the bottom. I'd be more interested in staying with what's strong. And that's what I mean by using the playoffs as in my analogy here, is that you don't want to invest your money in teams that don't make the playoffs. You don't want to, if the only way to manage our portfolio, our retirement portfolio, was to use NFL teams, if they were investments, wouldn't you just want to have your money invested in the playoff teams every year? And then if a team doesn't make the playoffs next year, then you just sell that team and buy another team in its place, whichever team did make the playoffs. Your portfolio would do a whole lot better over the long term, as opposed to sticking with, let's just say, my beloved Cleveland Browns between the late 90s and 2019, where it was dead money for a really, really, really long time. So what we want to do here, I guess the message of the episode is we want to stick with the playoff teams. We want to realize that when interest rates go up, bonds go down, and we want to be paying attention to our bond portfolios and realizing that growth is not guaranteed, interest isn't guaranteed, and it's also not guaranteed that bonds are safe investments all the time. It's going to make a difference every single time you buy. You reallocate your portfolio, and you're determining which bonds you're going to buy. You need to make sure that you're invested in ones that are correlating or not correlating with the interest rate environment that we're in. And if you had to put if you put a gun to my head and said, where do you think interest rates are going to be 15 years from now? I'd say they're probably going to be higher, not lower. So obviously, time will tell if I'm right or wrong. But if interest rates are higher 15 years from now, chances are some of these bonds aren't going to be doing nearly as well as some of the other investments we discussed in this episode. So that's it for today's show. Please feel free to share this episode with your friends and family. And if you'd like to discuss your personal situation further, easy for me to say, remember that you never ever have to be a client to ask a question. If you'd like to set up an intro call or a Zoom meeting, just head over to our website at libertaswealth.com on the contact page, and you can actually click on a link there that'll give you access to my calendar. As I always say, there's thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Please be sure to subscribe both on iTunes and YouTube so you'll get alerts whenever we post new episodes. A lot of the time, I'll post one of these episodes on a Wednesday or a Thursday, but we won't actually send out the notification until Friday. If you're a subscriber, you get the notification right away. And then, of course, remember, you can go to our website at libertaswealth.com, and you can not only get these updates, but you can get updates on other screencasts, videos, and articles that we write delivered directly to your email inbox. Feel free to follow us on Facebook at facebook.com/libertaswealth. I'm also on Twitter at Adam Koos, as well as Instagram at Financial Surgeon. So thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.